Are big tech dividends now a thing? Are rate cuts coming or rate increases? And stagflation is creeping back into the national narrative. This and our chart of the week on this episode of Investment Insights. Thanks for tuning in today. My name is Jay Coulter. Joining me as always, Austin Graff and Adam Muller. Let's recap what we saw in the market last week. Equities notched their best week in 2024 after Microsoft and Google reported earnings. The consistent theme on the earnings call was that the heavy investment in AI and cloud computing is starting to pay off. The heightened interest rate volatility of recent weeks has now subsided, which has given investors comfort. The 10-year Treasury is now at 4.67%. Nearly 50% of all the S&P 500 has reported earnings thus far, which on average, top line growth is coming in at 3.8% and bottom line is coming in at 3.4%. Gentlemen, a lot of great data points. Austin, what are your thoughts?
It tends to show that the recent I would say energy in the market or positive view of the market seems to be playing out. Now, there is a bit of a push-pull going on right now between interest rates and earnings momentum. I think the expectation is that earnings accelerate in the back half of the year, given where interest rates appear to be remaining higher for longer. And it'll be interesting to see how that kind of push-pull plays out through the remainder of the year, depending on if we do actually get the earnings momentum or not.
Adam, what's your take from what we saw last week?
My take is it was nice to see earnings take a driver's seat in how stock prices moved for a few days, rather than sort of macro issues and global conflicts. To actually see what are the financial statements of these companies, how much revenue and income are they generating, and does that mean they're overvalued or undervalued? And that was a nice change from what's been going on most of the year.
Let's dig into our three insights for the week. Last week, Alphabet announced that shareholders of record on June 10th will start to receive a dividend across all share classes. Lots of things going on in big tech dividends. Austin, what's your take?
It's really interesting because this has been a part of the market that historically has not paid much in the form of dividends. We saw not just Alphabet last week, but the quarter before, we saw Meta kick in a dividend as well. While these dividends are still relatively small, they're likely never going to reach kind of average S&P 500 dividend yield, but they do serve a purpose of paying a decently sized check to the founders of many of these companies. One of the reasons we're seeing dividends right now, though, happens to be because the federal government is preventing them from buying additional companies. So as they're generating a ton of cash from their base businesses, they really have nothing to do with it. So I guess the only option they have, aside from buying back a ton of stock and reducing their float, is to pay out a dividend. I expect there to be more dividends coming from these cash-rich companies, mainly because investors are no longer rewarding these moonshot projects that tend to have less than 50-50 probability of working out. And they're starting to reward companies that focus on free cash flow. As that free cash flow builds, distributing to shareholders is a good thing. And I think that shareholders will continue to reward those companies going forward.
Adam, let's talk about the Fed and rates. What are your insights on what we should be looking at today?
Yeah, it's fascinating how this has evolved. And the theme here is be very careful as you think about macro projections. You think back to the end of last year when the Fed seemed to take a turn to the dovish, and people started to project 4 or even 6 rate cuts this year. And then slowly over the course of the year, those estimates have gone down to 3, to 2, to 1, to maybe none. And some of the talking heads have even started saying, hey, there's the possibility there could be a rate increase if things don't go in the direction that the Fed wants. So, the macro forecasters are very good at being wrong slowly and making sure that you can never really be too critical of them. And the reality is you've got to look through it, take a longer term view, and be realistic about what could happen. We've been saying for a while, and I've been saying that there's no reason for the Fed to cut until something happens to the economy. And the data, it hasn't happened yet. If anything, we're moving maybe in the other direction. So it's an evolution, and it will continue to evolve over the course of the year.
My insight for this week is around stagflation. Started to creep back into the narrative. Ed Yardeni was on CNBC earlier today saying he does not see signs of stagflation. If you're not familiar with what exactly stagflation is, Investopedia calls stagflation an economic cycle characterized by slow growth and a high unemployment rate accompanied by inflation. I feel like sometimes there are different narratives around exactly what stagflation is. It has political overtones, but when you're talking to investors and watching the financial news media and you hear that word, it's important to keep in mind generally how it could impact your portfolio. Team, do you have any thoughts on how investors should look at stagflation today?
I think stagflation is a slow killer to wealth, mainly because most people don't think about inflation in a no growth environment. And it does seem like something that individual investors should be very focused on, even if there hasn't been much inflation for the last decade plus. Now, I'm not a big fan of these labels because, as you can see in this case, the two really, I would say, catastrophic things for individual investors is long term inflation with no growth. Now, a lot of people aren't naming it stagflation because we still have a pretty good employment environment. However, that doesn't help out if the value of your dollar goes down while you can't generate any returns on that from an investment perspective.
Adam, any thoughts on stagflation?
It just seems like it's a little early to start throwing the stagflation flag out there because the economy from a jobs perspective is still doing fantastic. I don't know the growth. One GDP print does not mean slow growth, especially, and that number could very well get revised in the future. And if you look at what a lot of the projections have really just bumped the growth they thought they were going to see in Q1 into Q2 now. So, time will tell, but it doesn't feel like the data suggests we're in that environment. It's just a fun word that someone invented and probably got a Nobel Prize for that people like to throw around to sound smart. But really, just look at the data. The data doesn't suggest the data suggests that the job market is still great and growth is still there.
Let's close with our chart of the week. So we were just talking about stagflation. One of its components is inflation. I've never personally been a big fan of using government-produced inflation data, but it does provide some useful points. So as of today, inflation is sitting at 6.45%, core inflation at 5.71%. If you're not familiar with core inflation, that's when they take things that you don't typically use, like food and energy, out of the calculation. Obviously, I'm being sarcastic. I never like that metric as a whole. I think what's important to note, as you can see from this chart, though, is the direction of inflation. Team, what do you think about this inflation chart and the applications today?
Look, the chart suggests that the Fed's job is not done if they really want to contain inflation and get it down to the levels they've suggested as their target. And if you were to take the Fed at face value on where they want to be, and you were to look at how the inflation data has ticked back up a little bit recently, you'd be in the camp that there could very well be a rate cut in the second half of this year. Whether or not the Fed is influenced by the fact that it's an election year, we could debate that. But it suggests that we're in a little bit of a hiccup right now in this path to lowering inflation back to the target that the Fed wants.
Yeah, I think one thing to think about here is just that the chart kind of highlights how the Fed might not necessarily control inflation as much as they'd like you to believe. There's another side of the component here, or a side of the spectrum here, that involves fiscal policy. So that the federal government's actually printing money and spending it pretty freely. And it's hard to say that the Fed completely controls inflation just through interest rates, because when there's a lot of additional money sloshing around in the system, it doesn't really matter what the Fed does from an interest rate perspective. So I think people need to be aware of the fact that regardless of what Powell and company want to do, inflation might not listen to them.
Thanks for tuning in to this week's episode of Investment Insights from Opal Capital. To learn more about our firm, visit opalinvest.com.
The viewer of this content should not assume that any information presented or made available on or through this media channel is receipt of or substitute for personalized investment advice. Opal Capital LLC is an SEC-registered investment advisor. Registration with the SEC does not imply a certain level of skill or expertise. Opal provides its services exclusively to registered investment advisors, either through a sub-advisor relationship or a model provider consulting arrangement. For a copy of Opal's disclosure documents, please visit advisorinfo.sec.gov and follow the search instructions. Visit opalinvest.com or opaldividendsdigest.com to learn more.